So this is related to the RAROC and the profit planning. So banks are what? Banks are commercial organizations. They are to earn the profit for the sustainability. So they are to earn the profit for the sustainability. So they are to earn the profit so as to provide the good return on the equity, because they have raised the capital by way of the equity, and further they are to provide good returns on the equity, and also they do act as a intermediary. What does it mean? It means that they are accepting the deposits and further using it for the investment and lending purposes. So whatsoever the deposits which have been accepted by the bank, the banks are also having the obligation so as to pay the interest on those liabilities. So these are the liabilities on which the interest is to be paid, and further that interest they need to earn it from the assets and further in the investments also. Okay. So they have a role of the financial intermediary. So they are expected to give some fixed return to the depositors. Banks are therefore required to be cautious in their dealings and further manage the risk in a prudent manner. Secondly, banks' income arises from the three sources. What are those three sources? Let us have a look at it. First of all, it is the interest income. Secondly, it is related to the fee-based income. And the third one, it is the treasury income. We have already learned all the dimensions related to this. And further, there are the regulatory norms as per that the banks are to maintain the CRR and SLR. That is a liquidity that is to be maintained by the bank, that the bank cannot be used for the lending purposes. Let us take the case that if 18% is the SLR, that is the statutory liquidity ratio, and 3% is the CRR. In that particular case, the bank cannot basically utilize 21% of the net demand and the time liabilities. Is that clear? So that is related to it. And also the banks are required to have a proper blending of investment in government securities and the credit portfolios so as to maximize the profits for a given level of the risk appetite. What does it mean? Now, in the case of the government securities, there is almost nil risk or the zero risk is over there. But in the case of the credit portfolios, there is a risk available in the market itself. So banks are to make a composition, a quite great and fair composition of the government securities and the commercial loans related to that, that the risk is under the appetite, that the risk which can be absorbed by the bank itself. And further, the second major factor of the major source of the income, that is basically derived from the fee-based income. So traditional services such as the demand drafts, remittances, banker check, traveler check, they are also prevalent, but new services are also added up, like the repository services, internet banking, e-commerce transactions. Those also boost the non-interest income, or we can say fee-based income. So banks also have ventured into the cross-selling of the mutual funds or the insurance. That is also a extra dimension of the income. So banks are required to keep in mind the operational risk, because these particular operations from where the bank is earning the non-interest income, there are operational risks involved in it. So what we meant to say, so whatsoever the dimension from which the bank is earning, it is basically having involved some kind of the risk factor into it. Okay. That is involving some kind of the risk factor into it. And further, the treasury income. In case of treasury, we have learned related to the banks as per the treasury department, they do invest into the invest for the proprietary positions such as in the capital market, in the securities market, in the foreign exchange. We can do understand that they can be a huge profits that the treasury department can earn for the bank itself. But also there is possibility of the huge losses also. So banks can also undergo the huge losses if the proper limits are not maintained. Is that clear? Further, it is related to the expenses. So the expenses there are two major type of expenses over there. One, it is the interest expenses, and the other one, it is the operating expenses. So in a nutshell, we can say profitability of the bank is a function of 6 variables. What are these 6 variables? Let us have a look at it. It is the interest income, fee-based income, trading income, and the interest expenses, staff expenses, and the other operating expenses. Okay, so these are the 6 variables of the profitability. So for the first 3 cases, that is the interest income, fee-based income, trading income, we are to maximize our incomes and we are to minimize our expenses so as to maximize our profitability. so as to maximize our profitability. That is the simplest funda related to the profitability. So that whatsoever I am receiving and what I am paying, the difference is basically the profit. But also there is a probability of loss. There is a probability of loss because bank is taking a extra risk. Whensoever the bank is taking a transaction, whether it is related to the investment purposes, whether it is related to the lending purposes, there is an extra dimension of the risk is involved over there, which is basically related to the RAROC, which we will be considering over here. Is that clear? So now risk aggregation and the capital allocation. So let me tell you, in addition to complying with the regulatory guidelines and the minimum capital regulatory requirements, banks should critically assess their internal capital adequacy. As we have learned under the second pillar, that is was the supervisory review process, we learned related to the ICAAP, that is the internal capital adequacy and assessment process. Okay, so banks need to basically have a model by virtue of which they can measure the internal adequacy of the capital, and further they should be maintaining that particular capital also. And also we must be looking at the future capital need, that what would be our future capital need. We'll be looking into that particular dimension also. Is that clear? So as a part of the process of evaluating the internal capital, a bank should be able to notify, identify and evaluate its own risk. So whatsoever the risks are over there in our bank profile, under the bank portfolio, those all risks must be determined, and further based upon that the capital is also to be allocated. Is that clear? So at the head office level, aggregate risk exposure should be receive increased scrutiny. So at the head office level, or we can say on the macro level of the bank, on the macro level of the bank, or on the portfolio level of the bank, all the risks must be aggregated. All the risks must be aggregated. There must be summation related to that. So banks use different ways so as to estimate the aggregate risk exposure. So we are dealing with the different risk, whether it is a credit risk, market risk, operational risk, strategic risk, reputation risk. Different types of risks are over there. But we are to do what? We are to basically aggregate all those risks. You have to aggregate all those risks, and different approaches are being used, and the most used approach is the RAROC, that is a risk adjusted return on capital. Risk adjusted return on capital. So each type of risk is measured to determine both the expected and the unexpected losses. So we'll be covering both the expected losses and also the unexpected losses. Whenever I say the unexpected losses, what does it indicate? It indicates the abnormal situations. One, it is a scenario that is a normal scenario under which the losses can be arising, and second is the unexpected losses, that is related to what? That is related to the valuated risk in the case of abnormal cases. So we'll be looking at the worst case scenario also. So key to RAROC, that is a risk adjusted return of capital, is a matching of revenues, cost and risk on the transition and further or portfolio basis over a defined period of time. So what we'll be doing, so key to RAROC, that is risk adjusted return on capital, is that we will be looking at on the transactional level or on the portfolio level, that what we are basically earning, that what we are earning, or what are the revenues, and further what are the expenses over there, and what are the risks involved in that particular case. So that would be the key related to that. We will be defining what would be the RAROC, that what would be the RAROC. Definitely here it is, the VAR is related to the normal situations only, but the different scenario analysis and the stress testing is related to that, where we'll be covering the extreme conditions too. Okay,